9 out of 10. That is the number of individual investors who underperform a simple index fund over a 10-year period. 9 out of 10 people who actively try to beat the market, who research stocks, follow the news, buy and sell based on what they read, end up worse off than if they had simply done nothing. Read that again. Doing nothing outperforms doing everything. How is that possible? How can the average investor, armed with more information than any generation in history, consistently lose to a fund that simply buys every stock in the market and holds them forever? The answer is not what you think. It is not the market. It is not the economy. It is not bad luck. It is something far closer to home. Today we are going to expose the real reasons why 90% of investors lose money, and more importantly, exactly what you can do to make sure you are in the 10% who do not. Before we get into the reasons, let us look at some numbers that most people in the financial industry would prefer you never saw. Over a 15-year period, more than 90% of actively managed funds underperform their benchmark index. These are not amateur investors. These are professional fund managers with teams of analysts, decades of experience, and access to information that ordinary people will never see. And 90% of them still lose to an index. The average retail investor, according to research, earns just 2 to 3% per year over the long term. The S&P 500 index over the same period has historically returned around 10% per year. The difference between 2% and 10% over 30 years is not small. It is the difference between a comfortable retirement and financial struggle. So why does this keep happening? Why do intelligent, hard-working people consistently make the same costly mistakes generation after generation? There are 7 reasons, and every single one of them is within your control to fix. Reason number 1. They let emotions make their decisions. This is the single biggest destroyer of investment returns, and it operates invisibly, which makes it so dangerous. When markets rise, investors feel confident and buy more, often near the top. When markets fall, investors feel terrified and sell, often near the bottom. Buy high, sell low. Repeat for 30 years. Wonder why you have nothing left? Research by Dalbar, one of the leading financial research firms, has tracked this pattern for decades. They found that the average investor earns dramatically less than the market. Not because the market is bad, but because investors exit at the worst possible moment. Every crash feels like the end of the world when you are living through it, and that feeling makes selling seem like the rational thing to do. But it is almost always the most expensive thing you can do. Reason number 2. They try to time the market. Every investor, at some point, believes they can see what is coming. The market looks overvalued, so they sell and wait for the crash. The market looks too risky, so they hold cash until things calm down. They wait for the perfect moment to get back in. There is only one problem. Nobody, not a single investor, analyst, economist, or fund manager in history has consistently and accurately timed the market over the long term. Nobody. And here's why this is so costly. A study by J.P. Morgan found that if you missed just the 10 best days in the stock market over a 20-year period, your returns were cut in half. Missed the 20 best days, and your returns almost disappeared entirely. The 10 best days in the market almost always happen during the most frightening periods. The exact moments when market timers are sitting on the sidelines, waiting for calm. Time in the market always beats timing the market. Reason number 3. They pay too much in fees. This one is silent and slow, and it destroys more wealth than almost any other mistake. A fund that charges 1.5% per year sounds harmless. 1.5%. It barely registers. But over 30 years, that 1.5% fee can consume 30 to 40% of your total potential wealth. Think about that. 1/3 of everything you could have had, quietly taken from you in fees you barely noticed paying. The antidote is simple. Low-cost index funds. The best index funds in the world charge less than 0.1% per year. Some charge 0.03%. The difference in fees between an active fund and an index fund, compounded over 30 years, can literally mean hundreds of thousands of dollars. Reason number 4. They chase performance. Every year, some stocks are on fire. Some funds are posting extraordinary numbers, and the financial media covers them breathlessly, night after night. So investors pour money in. They buy last year's winners, convinced the performance will continue. It almost never does. There is a phrase in investing that every regulator in the world requires fund companies to print on their materials. Past performance is not indicative of future results. Most investors read those words and ignore them completely. The hottest stock of last year is usually the worst performer next year. The top fund of this decade is rarely the top fund of the next. Research after research confirms the same finding. Chasing past performance destroys future returns. Reason number 5. They do not diversify properly. Putting all your eggs in one basket is one of the oldest warnings in investing, and yet people do it every single day. They put everything into one stock they love, one sector they believe in, one country they live in. And when that stock, sector, or country has a bad decade, their entire portfolio suffers. True diversification means spreading your investments across different companies, different industries, different countries, and different asset classes. Not because every one of them will perform well, but because you never know which ones will. And a globally diversified portfolio captures the growth wherever it happens in the world. Reason number 6. They overreact to the news. The financial news industry has one job: keep you watching. And the best way to keep you watching is to make you feel like something urgent is happening right now that requires your immediate attention. Recession fears, trade wars, interest rate decisions, inflation data, geopolitical crises. Every week there is a new reason why the market might crash, and investors who watch the news obsessively trade more. They react to every headline. They adjust their portfolio every time a pundit says something frightening. More trading means more fees, more tax events, more opportunities to buy high and sell low. Research consistently shows that the investors who trade most frequently earn the lowest returns. The best investors check their portfolios as rarely as possible. They tune out the noise, and they stay the course. Reason number 7. They do not have a plan, and they do not stick to it. This is the foundation of everything, and most people never build it. Without a clear investment plan, every decision becomes emotional. Every market move becomes a question. Every piece of news becomes a reason to act. A real investment plan answers 5 questions. What am I investing for? When will I need this money? How much risk can I genuinely tolerate? What will I invest in? And what will I do when markets fall? That last question is the most important of all, because markets will fall. The investor who has already decided what they will do when that happens is the investor who survives it. So how do you avoid these 7 traps? How do you become the investor who consistently wins when 90% are losing? The answer is simpler than the financial industry wants you to believe. Rule 1. Take emotion out of the equation. Automate your investing. Set a fixed amount to invest every month and let it happen without you having to make a decision. When you remove the decision, you remove the emotion. Rule 2. Invest for time, not for timing. Get into the market and stay there. Do not try to predict crashes or recoveries. Do not sit on cash waiting for the perfect moment. The perfect moment does not exist. Rule 3. Keep costs ruthlessly low. Choose low-cost index funds. Compare expense ratios. Every fraction of a percent you save in fees stays in your portfolio and compounds for decades. Rule 4. Diversify broadly and globally. Do not concentrate. Spread your investments across the world. Own a piece of thousands of companies in dozens of countries. Let the global economy work for you. Rule 5. Turn off the noise. Stop watching financial news daily. Stop reading every market prediction. Stop reacting to headlines. Check your portfolio quarterly at most. Let it grow in peace. Rule 6. Write your plan and commit to it. Write down exactly what you will invest in, how much, and for how long. And write down what you will do when the market drops 20%, 30%, 50%. Then when it happens, you follow the plan, not your feelings. Here is the hardest thing to accept about investing. Being a great investor is boring. It does not involve exciting stock picks. It does not involve reading charts or following trends or catching the next big wave. It involves doing almost nothing. Month after month, year after year, decade after decade. But human beings are not wired for boring. We are wired for action. We feel like doing nothing is irresponsible. We feel like we should be responding to what is happening in the world. And that feeling, that itch to act, to respond, to do something, is what costs 90% of investors their returns. The legendary investor Jack Bogle, founder of Vanguard and creator of the modern index fund, said it perfectly. Do not do something. Just stand there. 3 words that go against every human instinct. 3 words that have created more wealth for ordinary investors than any strategy, any system, or any expert recommendation in history. 90% of investors lose, not because the market is rigged against them, not because they are not smart enough, not because they did not have access to the right information. They lose because they are human, because they feel fear, because they chase excitement, because they trust their instincts in a game where instincts are almost always wrong. The 10% who win do something that sounds impossible, but is actually very simple. They get out of their own way. They build a plan. They automate their investing. They diversify. They keep costs low. They ignore the noise. And then they wait. Patiently. Quietly. Consistently. While 90% of the world reacts, panics, chases, and loses. The stock market is the only place in the world where things go on sale and people run out of the store. Now you know why. More importantly, now you know how to be different. If this video opened your eyes, subscribe to Wealth Doctrine for weekly investing wisdom. And drop a comment below. Which of the 7 mistakes have you made? Be honest. The first step to fixing a mistake is admitting you made it.